Good afternoon. My name is Tim Berry. I am an independent consulting actuary hosting today's NOCA CPD event. NOCA's purpose is to create successful economic opportunities for insurers and actuaries collaboratively. We organise CPD events and provide actual training courses such as R, Python, MATLAB and others, all of which are shown on our website. Our members include insurance company actuaries, consultant actuaries, actuarial recruiters and other risk professionals. Today's session is titled Alternative Data Use Case in Life and Health Risk and will be presented by Doug Ricks and Adam Musnitsky. Adam is a global products actuary for Swiss Re based in Israel, focused on health and wellness products and alternative data research. He previously consulted to several global startups developing alternative data propositions. Prior to that, Adam worked for Discovery from South Africa with a focus on the link between health and wealth. Doug is the Global Head Underwriting Research and Development for Swiss Re, based in Cape Town. He has 16 years underwriting experience working through Africa and the Middle East and in a global role since 2019. He has worked with many life and health insurers globally to develop and manage underwriting and product innovations. More recently, this includes a strong focus on health and wellness propositions, as well as using alternative data in risk selection. This presentation has been prepared for general information purposes only, and any views expressed are not necessarily the views of NOCA. The session may count for up to 1 hour of your CPD, provided it is relevant to the nature of your work or role and addresses a personal development need. There will be time for questions near the end of the session, and you can register questions using the Q&A button. Let's get started with a presentation titled Alternative Data Use Case in Life and Health Risk. I'm delighted to welcome Adam and Doug. Over to you.
Okay. Hi, everybody. It's great to be talking to you today on behalf of both myself and Doug. We're very excited to present this to you today. That our topic is alternative data in life and health risk assessment and international experience. We're both part of a global team, so we'll give you our global experience that we're seeing. Now, as actuaries, we all know that our bread and butter is understanding risk, working with risk, learning about risk, becoming expert in risk, whether we're becoming risk management, part of the risk management team, or whether we're chief risk officers, or even within pricing. It's something that as consultants is essential to understanding and giving across to people that you're working with an understanding of risk. Now, what's very interesting is risk assessment within life and health insurance is the one area where people who aren't so focused on the typical pricing journey get involved. People who didn't necessarily you don't almost have to be an actuary in order to work in this area. So our global head of underwriting, R&D, Doug Ricks, that's the one area where underwriters get very involved. So I'm going to hand over to Doug and he'll tell you a bit more about risk assessment and the use of alternative data.
Yeah, thanks, Adam. Great to be talking to you today. It is a pleasure. This talk, just for a little bit of background, is a talk that originated when we landed up finding a lot of insurtech vendors who had access to data assets like the UK Biobank. There are several others in other regions, as well as also in the UK as well. They develop models, often academics who have done PhDs and looking to monetize their work and essentially using machine learning models, in some instances AI models, and then taking these models to insurers saying these models can entirely replace your risk assessment process. And the reality is that we landed up coming across that so often that we thought we better do a little bit of internal training just to make sure that our account managers, who aren't always necessarily deeply technical people, that they have some appreciation of what some of the practical challenges are. So it gives you a little bit of context. Just as a little bit of a technicality, those who perhaps focus on medical reimbursement products, while a lot of this does have overlap to it, we will focus more on life products. So that would include the critical illness and the disability income products. and we will have a tendency for our examples to use health and wellness examples because it's a major industry topic, but the principles nonetheless apply to lots of other areas of alternative data and this mystical concept of data. What's your data strategy? How are you using it? Yeah, so let's move on. Adam?
Sure. So we'll start off, this is our agenda for today. We'll start off by looking at the global world of alternative data. We'll take a quick look at what exists in the market around the world and how it's being used. Secondly, we'll move into a set of core principles in order to assess this data. When an insurtech is coming to you with new data, or when you're accessing new data, how should you understand the value of that data? Thirdly, we'll look at some real live case studies that we're seeing across the globe and how insurers, insurtechs are approaching this type of data and how we are assessing this data and recognizing it. And lastly, we'll walk away today with a summary of what we've discussed, as well as some next steps for you to use as you go forward in working with clients or working with different insurers. So we'll still take a look at the next slide. So if we can go through to the next slide. Sorry, go for it.
Yeah, it's a little bit of a different process doing this on Zoom rather than doing this in person, which is something Adam and I just did a couple of days ago in another market. So most of you will be quite familiar with this process. It essentially paints a fairly simple picture of the fact that applicants more or less go through a very kind of conveyor belt process when they're providing or applying for insurance, life insurance in a traditional space. There may be pre-selection through, for example, banks or other affinity schemes. Some insurers, I mean, South Africa has the famous Vitality example, but there are plenty of other examples of post-issue opportunities for kind of engagement plays. So there's often pieces around that, but most go through a quote underwriting, which means answering a whole bunch of questions about your health and possibly doing some medical tests, and then being able to either be accepted in probably about 95, 96% of cases, and then your policy issues. But it's very much a process that everybody more or less comes into, goes through in a straight line. And if you aren't able to provide pieces of the information, often that kicks you out of the process entirely. So when we talk about alternative data, and if we start getting a little bit specific, this is a graphic from a market study, a market intelligence, market research firm, CB Insights in the US. It was probably out of date about 10 minutes after it was actually created. So the names are not all up to date. They're not fully comprehensive. But I think the thing that I really like about this, because I think when people say, oh, what should I be doing in the space? And it's a question we get asked a lot. This starts to categorize it, and it moves it from the kind of the nebulous into the quite tangible. And that process of being very, very specific about what you're trying to achieve using any additional data in your processes has to be very specific, both in order for you to know how to use it, to be able to assess the impacts on customers, as well as in terms of kind of building your business case to determine the return on investment and whether that looks, the net margin is in your favor as an insurer. And so you can see a few different types here. UK will have a number of these available. EHR is obviously rapidly growing, although its integration into life insurance is still relatively low compared to somewhere like the US. Wearables have been around for a long time. And as we say, just for the examples that we'll be running through today, that's where we'll focus a lot more of our time on, but the principles nonetheless apply across a wide number of these tools. And then one thing that I personally find very interesting, some people might call it mHealth, mobile health, or digital biomarkers. This particular company calls them biometric screening tools, whereby you might have an app on your phone that takes a video feed of you, sound clips of you, things like that, and tells you about your health. And so it's just really important to be quite specific about what you're trying to achieve with some of these things.
Now, it's all good and well to get this data, but what do we want to do with this data? So this is something that's probably familiar to most actuaries, so we'll run through it relatively quickly. Firstly, you're able to take this data and tailor products with appropriate benefits. They offer discounts based on people who are doing well using a certain data point. Next, you might be able to use this data as an underwriting segmentation to offer preferential rates or to offer discounts to those policyholders who are healthier. You may also be able to personalize the underwriting journey. This is something that's very common in today's fast-paced world, where the average younger person would like everything quick and fast, so we can give them a more personalized, tailored journey that's faster for them. That's something that's very valuable. We move from the pre-inception world into the post-inception world. There's also the ability to use this data to understand how a person is interacting, engaging, how their health is changing over time. And then lastly, the ability to take that change over time and move it into the world of prevention, of trying to intervene and stop a person from becoming, stop a person from them having a disease or their mortality increasing. So back to our agenda, we'll now look at some core principles for how to assess this alternative data. So now that we've seen what data is out there, it's now a case of understanding how to assess it. Now we've got here 4 questions that we typically see that that people often take for granted. And it's fascinating how most innovations simply fail across these 4 metrics. Now, if I run through these 4 metrics, what's interesting about them is a certain data point or in certain insurtech's offering or a certain data set may be good on one of these data points or maybe good on 2 of these data points. But if they fail on the other 2 data points, there's the risk that overall, it's not a valuable benefit to offer within your value proposition. Now, what are these 4 questions to ask? The first one is just speed in terms of getting access to this data. Is it quick to get? Is it going to help improve your process? And will clients be happy with the speed that it's happening at? Secondly, how much does the data cost? Is it significantly expensive and therefore that will stop you from being able to use it and offer it to clients? Or does it need to be offered at a certain target market where they're more likely to be able to afford it? We always talk about the risk prediction, our ability to predict a person's risk. Does the data help increase that level of understanding of a person's risk? And is the marginal benefit that we get out from that increased risk prediction valuable enough? And then lastly, just in terms of the practical usage, both for insurers as well as for policyholders, is it easy to use? Is it something that is it plug and play? And across these 4 questions, we see different data points giving different value across each of these 4 questions. And really what it's a case of doing is being able to answer all these 4 questions, see where the different data or different insurtech offerings sit, and at the end, creating a business case out of it, whether that's an ROI, return on equity, being able to say, the ROI, the benefits versus costs across these 4 questions, the benefits exceed the costs. That's what we see as the recognizable approach to do this. So how do you go about doing this? We'll take a look at the next slide where we've created a set of principles in order to assess this. Now, these principles boil down to what we call the 3 C's: context, credibility, and correlation. Context is really the core of this, is understanding when you get this data, how do you intend to use it, and at what stage of the customer journey. Doug spoke about the conveyor belt of the experience that a a policyholder goes through first when they take out a policy and the experience post-policy. So the context here of using that data is essential because there's a material difference when you use it. There's also credibility. How good is the data in terms of its accuracy, its ability to predict and identify fraud, its ability to help with understanding relative risk and understand a person's experience across either mortality or morbidity or wherever we're tracking. Next, if we move into the world of correlations, this is really the core. Now, as actuaries, we all understand correlations, and this is really the bread and butter for us of understanding how good a data point is, especially relative to another data point. So when we're introducing new alternative data into the mix, things that didn't exist before, it's very important to understand how that correlates relative to the existing data. And based on that, it allows us to assess what might happen to our insured pool, what could be the pricing impacts and the underwriting impacts. Really, that boils down to, is the value added greater than the effort involved? From a regulatory perspective, something that's very topical and medically, will this stand up in a court of law? Is this data going to add, or is it going to create ethical questions? And lastly, from a pricing perspective, will the data lead to additional anti-selection, especially as one of the cases we'll speak about today? If you use this data to replace existing data, will you encounter material anti-selection? So that's our 3 principles for assessing the value of new data.
Okay, thanks, Adam, for sharing that. And I think the part that I always find very intriguing is that we have some amazingly intelligent people in the industry, but we also have some very curious minds in the industry. And you see these new propositions, these new tools, these new opportunities, and there's often a very quick readiness and willingness to dive into looking at these opportunities without potentially looking at those core principles that Adam was talking about. So if we take one particular example from Asia, if you think that BMI is really well understood to have an association with increased mortality for when there's increased BMI, there's a technology in your phone that can take a little selfie from you, or maybe take a picture of your whole body. And if you just prop your phone up on your desk, it takes a picture of your body and works out a substitute for your BMI. And on the one hand, that's really great. We know obesity is linked to extra mortality and extra morbidity, but at the same time, it costs about $2 per scan in a market where most of your BMIs are very, very tight together in Asian communities. It's not like, unfortunately, we see a little bit more in the Western communities where there's a much greater spread of obesity across the BMI range. And ultimately, we know that we have probably, particularly in the Asian markets, within a pretty good confidence interval, that people haven't shaved off too many kilograms or added too many centimeters to their height to artificially lower it. So just by asking a client costs very little in an Asian market, and by charging an extra $2, it's a great, exciting technology. But answering those simple questions is something that that the insurers spend quite a lot of time not doing, I suppose, in that particular example. So again, really think about your customer experience. And talking about these apps, the credibility factor that Adam was talking about a little bit earlier, I'm going to show 2 studies from validation studies from 2 different apps that we've had the opportunity to investigate. There are dozens of them. We've looked at validation studies for dozens of them as well, but hopefully, without going into the details of the validation studies, these 2 illustrations that I'm about to bring up really highlight the nitty-gritty, that the detail that you've got to get into if you want to be successful in exploring these alternative data opportunities. And so this particular study was done by quite a well-known vendor, a really great marketing machine. I love what they do in terms of the customer experience, but at the same time, the validation was based off 58 subjects in actually quite a small rural hospital in an Asian, quite a small Asian market as well. And it was basically use whatever device you've got available to you in order to do the measurement. And this is their validation study that they've built the algorithm off of. This study on the right looks at 10,000 participants across a couple of different markets in Canada and China, really well-known hospital universities, really robust processes. You can see that they took the measurements with multiple devices to be able to kind of validate against best practices, make sure that the results were pretty accurate, and they have a really good understanding of where they're accurate and they're correct and where they're getting false negatives and false positives, etc. And that allows an insurer to be able to say, this is where I can work with this particular tool or this particular data asset. And without that, you're really going to struggle to be confident of how you're incorporating any particular tool or data asset into it. And so, again, without going to the details, hopefully this illustrates to you the concept that you need to consider. Correlations, and again, I should probably, just noting the time, move a little bit quicker. My apologies. If we think about correlations, and it's something that the health industry and our doctors tell us a lot, and I'm picking on BMI because it's easy to pick on it, is that often we're told that it's overweight people that have much higher risks of cardiovascular disease, cancers, diabetes, and that is absolutely true. There is an increased risk. But we often get asked, well, if I know that the person has got a normal BMI, do I really need to know about these other things? Because, hey, they must be healthy. But if we were to start using BMI as a proxy for health, we'd realize that we'd actually miss a whole bunch of other clinical diseases. So just, and that's a very simplistic example, but by the time you start building up from just that risk factor to a set of risk factors to perhaps a set of tests, for example, your traditional medical underwriting blood tests versus your medical examination versus your ECG, etc., you're able to appreciate that the correlations perhaps aren't as tight as we sometimes think. And so this example on the right, again, we're often told that as you become obese, your blood pressure goes up and your glucose goes up and everything else goes up and you become higher risk. And the graph on the right just demonstrates a correlation between your BMI or obesity and your systolic blood pressure. So it's the first number on your blood pressure for those of you who may be marginally less familiar with it. And on the one hand, there clearly is that positive correlation. On the other hand, there's actually quite a lot of noise around it. And if you look at it, you'll realize that there's actually quite a lot of people who are obese, but still normotensive, or hypertensive, but are not obese. And so somebody, and again, this is a very classical argument that you might hear from the independent financial advisor when they're trying to sell a product. Oh, do I really have to send them for a medical exam? They're good height and weight and they haven't disclosed anything else. Do I really need to understand these things? Or he's just a bit overweight. He's not got any blood pressure pills. Do I really need to? And the reason that we highlight this, because it's really simple examples that by the time you scale it up and you look at the receiver operating curves and the different arrangements of risk factors, you realize that all of these contribute a little bit towards the picture of what we need to develop.
So to take this a step further, we're going to run through two examples that we see, which we think represent this phenomenon that we're speaking about correlations. The first over here is a picture of an airplane during World War II that was taken. Now you can see here that this airplane is a set of red dots all around it. What happened is that this is an airplane that returned from war. So war was going on and the officers were trying to investigate where is the best place to protect the plane. So if we're sending planes out into war, how should we be protecting them? If we have armor, where should we be putting the armor? And the officers came and they came to their superiors and said, you know, we should be protecting all the armor around all these red dots. Let's find the place where the most red dots are, and that represents the place which is the most dangerous. And therefore, that's where we should plug in and we should protect the plane. And then then there was a person by the name of Abraham Wald. I know we don't have a live audience here in terms of what we can see, but if you're sitting at home by yourself, put up your hand if you've heard of Abraham Wald before. So feel free to do that by yourself. Otherwise, to tell you a bit about Abraham Wald, Abraham Wald was actually a researcher, statistician, and he was involved in this assessment of trying to understand these warplanes And he actually turned around and he disagreed with the officers. Instead, he said it's not the places where of the red dots where you should be focusing and putting the armor. Rather, it's the places where the red dots are not. Look at the places where you can't find red dots, and that's the place you should put the armor. Why is that? He was asked. He was saying the exact opposite of the officers. It's because the place right at the top where there's no red dots, that's the place when airplanes get hit during World War II that they don't return. The red dots are where planes do return. And so if we're going to try to get an understanding of what planes are going to get hit and not returning, which is our worst case scenario when we're in war, we should focus on the areas, these specific areas. And this is very interesting because it matches exactly with what we're showing here today. You can always focus on the red dots, and the red dots are valuable and they do help with understanding a person's mortality, but they're not the core. We mustn't forget that there's a core missing information, which is the white, which is really going to be the representation of a person's death. And that's the core of what we want to understand. We must make sure not to forget that missing information. I'll hand over to Doug to take us through another example of this.
Thanks. And just remember this example when we get to some of the case studies a little bit later, because as much as we use this as a bit of humor and a bit of an illustration, the principle really does apply in terms of some of how we should be thinking about these opportunities. I won't spend long on this. I think it's quite self-explanatory, but I do quite like the joke anyway. And again, hopefully you're having a little chuckle at home. And you may have noticed that Adam brought up this lovely lady, a very famous painting. We all know her well. But something that you might have seen from some of the agile management or agile approach management consulting type courses is this graphic on the right. And again, it feels like a pretty good illustration about how we need to think about alternative data, in that we don't always understand without direct correlations. And we are using the terminology a little bit loosely for those who are being super technical about the actual statistics. But we don't always understand when we get a piece of information, how does that link into the other pieces of information? Where am I losing my granularity if I'm going to start pulling out pieces of information that I used to use? So if I'm going to maybe get an electronic health record, for example, how do I know how complete it is? How do I know if they didn't go somewhere else? How do I know if that test, even though it was done as negative, maybe it was done because they have high other risk factors for it, and piecing this all together can actually be quite challenging. So coming back to our process, we want to start sharing a few case studies, which we'll move on to shortly. And these are actually kind of real life case studies. Obviously, we're not presenting anything that's sensitive. And if I'm not mistaken, Adam, I think we've removed the UK examples just to make sure that nobody recognizes anything and we have any anti-competitive behavior. But again, the places, and you've got to be super specific when you're investigating opportunities, but the places we see these alternative data assets used the most is typically in your post-sale dynamic underwriting. So whether you think of the Vitalities of this world, whether you call it dynamic underwriting or healthy lifestyle rewards, in Japan, they could talk about cashbacks that could be conditional upon certain things, but it would be in the post-sale to try and incentivize certain behaviors in a host of different ways within the actual medical underwriting space. And then what's become much more prevalent is some of these insurtechs have, I suppose, almost realized through these validations within an insurance context is that they're not necessarily going to be able to replace entirely our old traditional underwriting, but we may be able to look at much more personalized experiences so that this isn't such a straight line conveyor belt. And essentially now we'll move on to some case studies.
So we'll start off with the use case, which is more familiar in the general markets, although less common in the UK, although it is starting to pick up, is the idea of using alternative data to get clients engaged and thereby offer them premiums which change and flex. or otherwise a set of rewards through the eyes of whether you call it dynamic underwriting or dynamic pricing, or just a rewards mechanism which reassesses a person's risk on an ongoing basis. So if we move to the next slide will show us, based on our global internal client research at Swiss Re, what we're seeing. And we're seeing that dynamic underwriting offers several different benefits. Firstly, based on the fact that you're tracking a person's health and building a health and wellness program, we see there's the ability to attract healthier lives and thereby have positive mortality selection up front. Secondly, through offering a health and wellness or engagement offering over time, there's the ability to have material behavior change, which results in better positive mortality experience over time. And then lastly, due to the engagement focus, we're seeing improved persistency. Now, what we also see across our global internal client research is a split of the values of the mortality experience in the market today. Now, the majority of health and wellness programs are being focused on physical activity. It's something which is easy to track through our devices, and it's really where the focus has been. And that's leading to the majority of mortality experience reductions being done in the physical activity space. What you are seeing, though, is each of the other different risk factors, and we've plotted here across both what we call the lifestyle behavior type risk factors, as well as the clinical risk factors. You're seeing improvements across all of them, and especially HbA1c, which is a marker of a person's ability to reach diabetes and become a diabetic. That's something that is becoming more and more topical, and insurers and insurtechs are focusing on this more and more. And so that's what we'd call the upcoming, one of the upcoming risk factors. Now, how valuable are these impacts? So we often get questions around the value of these programs, why clients should build one. So this next slide shows us an assessment of the potential mortality and lapse benefits that we see. We've looked here at one specific case. Other cases will mirror this, but not be exactly the same. And what you can see here, based on a 20-year term mortality product done in a market such as the UK, where there's not preferred stratification, not offering preferential rates, if a company were to implement a health and wellness program across the different various metrics that you're tracking, whether that's physical activity, fitness assessments through tracking a certain amount of a person's clinical stats, whether that's their blood pressure or they're going to a nutritionist, and through tracking these metrics and with the assumption of engagement being core to this. What you see here is that depending on how much people engage with the program, and that's through the use of the app, through going through fitness assessments, depending on the level of engagement, does result in the ability to get experience reductions across mortality and lapse. And those experience reductions can be as high as almost 4%. And that's across a total portfolio of a book when engagement is around 40%. It's closer to around 2.5% when your engagement rate is about 25%. And we see that 25% in terms of a business case scenario, that's almost your break-even point. Above that, in terms of a business case that we're creating for this specific scenario, there's the ability to even create a profitable scenario out of this. So we'll move across now to our next case, and Doug will take you through it.
Yeah, thank you. I realize that we're running through this quick fire. Our contact details available if you want to fire us off questions, and I see a couple of questions coming into Q&A. We hope to be able to pick up some of them by the end of this. But let's have a look at some of the case studies that we've seen within the medical underwriting space. So trying to identify if people are healthy or sick, and then charge them the appropriate premium. So in this particular example, again, we're looking at lifestyle risk because it's kind of the context that I mentioned at the start, but applicable elsewhere. In your traditional underwriting, you're looking very much at markers of disease. So can I look at the HbA1c and see if they're diabetic? And with looking at the lifestyle stuff, you're looking at the makers of disease. If I'm physically inactive, if I'm not eating well, if I'm stressed, and you can kind of follow all the biological pathways as to how some of this happens if you're a little bit more medically inclined. But one of the things that we see is that when you complement the two together, and this was in a product that was generally reasonably simplified, so they perhaps didn't have as much robust testing, and I think they offered a freemium access to a health and wellness platform. But what you could see is that users, once they had entered a whole bunch of their information, and now the insurer was trying to upsell them a protection product, is that we can see that the risk classification by just using clinical factors was nowhere as wide and as robust as being able to complement the two. And that doesn't necessarily seem a nonsensical conclusion, but it is a good reminder of the reason why we add a lot of these different pieces of information together. In the next scenario, we find that there was an insurer who was looking to try and essentially substitute out some of the medical examinations. They were quite happy to still do some of the blood tests that might need to be done, but they didn't necessarily want to have their applicants go and see a physician or a doctor or anything like that. Apologies that this seems to be showing off a little bit kilter in terms of some of the alignment, but hopefully you can still read that anyway. And essentially, they were trying to take out some of the medical testing that they used to do and that you're used to experiencing, and they were going to try and see if they could bring wearables in. And it comes back to that: how tight is the correlation? How kind of close is that the relationship between the medical tests that were going to be waived versus the wearables? And were you going to, even if it's not a perfect match between the two, are you going to have a net benefit? And again, we're really simplifying it down. We could kind of show receiver operating curves if that was really necessary. But if you think about running, the analogy is every good runner a person that has perfect BMI and perfect blood pressure? And a little bit the result of this, this quite noisy graph, as you can see, is that actually that correlation is just not that tight. So it's not to say don't get off the couch if perhaps you're not that active, but you also don't necessarily need to panic that that if you're not that active, that you're guaranteed to get a heart attack, which sometimes can be a little bit of the message. And so here you can see both people with disease and people without disease. And so this would have been major cardiovascular events and cancers that depending on the amount of exercise that they did, that you weren't necessarily going to get a good picture of whether they were obese. We could have done the same with blood pressure, and you would have seen that the correlation between blood pressure was equally as noisy. And while there are positive correlations, it's not necessarily that strong. And so when you're taking out a really high quality medical exam that's telling you very clearly what a person's risk is on some of these other attributes, you're not necessarily getting that just from looking at how much somebody exercises.
So do we recommend partially replacing existing data without a pricing impact? Well, this depends. Context here is essential. There are scenarios where it could work with little to no negative pricing impacts, but this would really be reliant on being able to identify pockets of healthy policy holders. If you can find here, we've got pre-filtered groups, which we recommend or say is probably a good place to start if you're going to start partially replacing, whether that's people who are already a part of a health and wellness program and exhibiting healthy behavior, or specific groups of people that you're able to identify as being representative of healthier, likely to have lower mortality rates and lower rates of fraud and anti-selection levels. Cross-sell and upsell, assuming a person was underwritten relatively recently, is also a good opportunity to identify these places where you could partially replace data. Now, it's important to obviously have a strong understanding of this data in order to do this. Now we'll head into the more contentious world of replacing, not just partially replacing one risk factor with another, but rather chucking out the old and moving on to a full new, replacing almost everything we know, throwing out traditional underwriting and getting into a world where we're replacing everything with the new data. Now, as much as this sounds like a crazy proposition, some of the insurtechs out there are saying this exact message. And I'll now hand over to Doug, and he'll show you a real life example of an insurtech, an insurer who are trying to do this approach.
Thanks, Adam. So this was an insurtech vendor. Again, came from academic background, had done some really interesting academic work, building AI models off the back of the UK Biobank, actually, and then determining outcomes of both mortality as well as other kind of major disease groups. And essentially, they looked at their model, they were super happy and confident. They went to a number of Asian insurers and said, with somebody's wearable data or exercise data, a couple of other points, age, gender, we can calculate the risk so accurately that you don't need to ask them questions, or your applicant questions, and you don't need to ask them to undergo any other tests. And for those of you who perhaps might not be familiar, in that center column where we've crudely labeled a calculation of the model, the METs is the metabolic equivalent of tasks, and that's just a standardized measurement of exercise, basically. So get your wearables, look at your exercise, age and gender, and we can predict your risk pretty accurately. And they come in with this example, which you can see here. They're showing 93% accuracy, and you think that is wonderful. And this comes back to Adam's earlier example of the Adam Vault, is that you're looking at all of these red dots and saying, these are the healthy people. But again, keep in mind, we're not actually, in this case, slightly flipped, but we're not actually trying to identify the healthy people. We're trying to identify the unhealthy people. And so through basic regression exercises, we're able to compare on a retrospective comparison between the data that was able to be provided by the vendor and run through their model, and compared that to the traditional underwriting decision. And we're able to see, well, where did they pick up people that were healthy and where did they not pick up people that were healthy? And that led to around about 7% of people that in some cases only quite a small difference in premium, but in some other cases much larger.
Just before we go into the slide, we do have some time for Q&A at the end of this presentation. So as I mentioned before, and just to reiterate, please feel free to add in any questions on the Q&A platform. Otherwise, feel free to contact us afterwards. So just to understand this remaining 7%, it's all good and well to do well in the 93%, but don't forget the 7%. And the problem with the 7% is that lack of correlation to the existing information. Now, what you see here is we've plotted a comparison between the physical activity that a person has, represented by what's called MET hours per week. MET is a representation of all the different types of physical activity together to standardize them. And what you can see here is that if we split people up into those who have diseases and those who don't have diseases, what you would have expected or hypothesized is those people with diseases would do very little physical activity, whereas those that have high physical activity, you wouldn't have expected any of them to have a disease. Yet, we don't see that. We see people with very high levels of physical activity who also have diseases. In fact, there isn't a material difference at high levels of physical activity, whether a person has a disease or not. And so by using physical activity won't necessarily tell us about whether a person has a disease. Again, showing this fact that there is not necessarily a strong correlation between them. And therefore, by missing out on the 7%, you're missing out on valuable information in understanding whether a person has a disease. And this would have a serious impact. We'll look at the next slide that will talk you through the hidden truth of this. As actuaries, it's all about really assessing the mortality cost. Now, if we look at this remaining 7%, what you'll see is that although there's a low frequency, there's likely a high severity. The remaining 5% that we've bucketed here across this case, and this would probably be representative of a typical case of young people who would have a certain disease in a certain region. They would either typically be declined or excluded from the product, or excluded from the features of the product and they would typically have a relative risk which is 3 or 5 times higher than people who don't have that disease. This is a significant impact in terms of costing, and not only is that impact valuable, but there's also the additional impact of what happens if you leave out certain information and your competitors ask it, and that's when anti-selection kicks in. And what we're seeing really across different markets around the world, not just in 1 or 2 markets, but often what we're seeing is that clients who leave out information head towards a simplified issue type journey where questions or application forms are significantly shorter, are seeing almost a doubling of mortality, largely due to that anti-selection impact. But clients are going and choosing them because they're asking less questions. So I now hand over to Doug to take you through the last of our scenarios.
So this is a space which is very much evolving, and we mentioned it a little bit earlier, just to say that as we kind of mature in the space of saying, look, how do we use this? How do we use that? And whether it's, again, I reiterated because we haven't so much drawn on examples of EHR or other things, but we see it again in a market like the US where EHR is starting to mature. People are starting to realize that I can't necessarily substitute out this new data set to replace my entire existing underwriting process. We're not at a place where we can say, just give me your digital file for your health records, and I'm super confident that that tells me everything I need to know about you. So what we're generally seeing most insurers who are playing in the space start to do is to come across much more personalized assessments. So they will start to look and they'll say, if we see that you have wearable data and you exercise well, we might start to say that you can buy a little bit more coverage before we start buying or insisting that you undergo certain medical tests, your typical cholesterol and glucose test. Maybe you can buy an extra 100, 200,000 pounds of cover before we start insisting that you undergo it. For accelerated underwriting programs or simplified issue programs, again, a very similar kind of concept. Is it whether it's product eligibility criteria that can be perhaps a little bit more quickly accelerated, and essentially starting to say that instead of having a single conveyor belt, you might actually land up having this omni-channel and kind of multi-directional, multi-dimensional element to how you risk select your customers. So instead of medical tests, for example, typically being done based solely on the age, perhaps the gender, and the sum assured of the policy, it might be done including a dimension of how active are you, how good are the records that we have available, can we do a quick digital screening on you with one of these apps, and you're able to kind of triage those people for a much more personalized customer experience. So just to wrap up.
Yeah, thank you very much, Doug. So I'll take you through some the summary of what we've done today, and I think it's important to understand this within the context of everything that we're talking about today. Is we're obviously very thankful to speak to NOCA for this presentation and to be able to speak to yourselves as consulting actuaries. And when you're working with insurers and trying to tell them how to assess this data, it's important that this is really what you use, a set of key considerations. Then insurers don't rush into the decisions. They take these 4 questions and find them valuable and work out how to use this. As consultants, you can really come across as strong by asking these questions, making it relevant, and then secondly, coming up with a set of principles to help insurers to make the decisions. Remember, the ROI and the benefit versus cost ratio is essential here to understand it across these different components, the context that the insurer finds themselves building a product in, the credibility of the data, how good is it, where are their holes, where are the limitations, and where are the strengths, and then understanding the actuarial component to it, the correlations, how the data compares relative to existing data. And then lastly, helping to advise insurers on the total experience. Everyone would like to innovate and make a difference and introduce new data in all the different areas, but typically you end up having to prioritize, and we see insurers needing to focus and prioritize relative to where their strategy is built. And that's why we see across the different areas the different ability to get a clear understanding of where to focus. As an example, engagement journey is something that's very popular. Underwriting is up and coming, but still a contentious issue, and you have to work out how to do it clearly. And Doug touched on very nicely the pre-selection, where there's the ability to come up with new and innovative things, but this is still a new and evolving space. Some next steps to take forward today: when working with insurers and working as consultants yourself, make sure that you identify both for yourself and for insurers what's their context, and make sure that that context matches clearly to their strategy. There's a clear match between them. Secondly, use the tools and principles that we've shown today in terms of how to assess the value of the new data that they're getting at. Don't just automatically assume that the new data has value. And lastly, tap into the world of research out there, reinsurers, such as the area that we sit in order to create an innovative offering for insurers and for customers out there. So thank you very much for the presentation today. We'll hand over to questions.
Thank you, Adam. Thank you, Doug. That was a fantastic presentation. It's very interesting to see how alternative data can be used perhaps alongside or even instead of traditional underwriting. The slides were fantastic, very nice and visual, and particularly like the systolic blood pressure compared to correlation with BMI and exercise with BMI. Thought those were fantastic. Okay, we'll now begin a question and answer session. Probably only have time for a small number. To ask a question, please either press the raise hand button or press the Q&A button to write a question at the bottom of the screen. I can see we've received a small number already. We've had a question from Niall Fenley, who is asking about alternative data sources. He says you've mentioned the UK Biobank. Are there any other publicly available or paid data sources that might be useful for UK actuaries to make a start with?
Yeah, thanks. The interesting thing about the UK Biobank is that they're pretty explicit about saying that it's not available to insurance protection providers. And so we spend, I won't lie, a bit of an eye-watering sum of money on academic institutions in order to be able to access those data assets and to kind of conduct those studies. There are a number of other studies as well. Typically, they work most effectively if you have a relationship with an academic vendor, is what we've found. But I mean, I think it's sometimes called CPRD or THIN. You can buy a license to that. Again, it's not necessarily that cheap. There are a couple of other studies, Whitehall studies, etc., that you can submit proposals to. But again, they tend to be very academic in nature. And those ones, though, however, are, if you're prepared to go through the academia part of it, are typically accessible. And there's plenty of others in other countries as well, sorry, Adam.
And it's just from a publicly available perspective. The one that we've referenced in some of the graphs today is the NHANES database, which is not a UK database, but it mirrors the data and correlations that we're talking about today. So that's a publicly available database. It's the NHANES, and that's something that's worth getting hands on.
US one.
Thank you. Thanks, Niall. An interesting point from David Simmons. We use the phrase alternative data, but maybe in a few years' time it might be normal data. Do you think the choice of words is important, and maybe there could be additional data instead of alternative data?
It's a great question. I think that's why we specifically used alternative data, because I think it provokes that interest from people. Additional data sounds like I think the reason for not using additional data is because additional data means typically will mean in addition to what currently exists there. Whereas we're trying to say, this data could act as a proxy or act as a replacement for what's currently used. So alternative meaning that typically entering into the world of insurers are trying new things.
I fully agree with this comment. It's all very relative. Sorry, I think I'm getting some signal delay. Apologies.
Okay, thank you. I thought it was interesting about when you have bought your insurance policy, and there may be incentives to exercise and even have better sleep and nutrition. I imagine it might need a fairly good incentive for people to wish to have their those factors monitored. Do you know how big these incentives may go?
Yeah, it's a great question, Tim. What we see, I won't quote the exact numbers, but typically what we see is that it's more about the perception of the incentives. So for example, if the incentive is perceived as being very valuable, even though it's not necessarily valuable in terms of financial terms, it becomes very meaningful. So for example, what's often recognized as quite valuable is things like say a flight benefit or something special, or say special tickets to an event, or discounts on certain products that you're very familiar with. It's almost similar to your retail outlets out there, that they tailor their marketing and their rewards in a certain way. That's the avenue that we see the providers who are trying to do alternative data and reward it. The way they're succeeding is offering rewards that are not necessarily costing a lot of money, but focused on creating perceived value and exactly what customers want. So what that means in practice, it doesn't need to be large numbers. It doesn't necessarily need to be a high proportion of, say, the premium, but it needs to be something that's valuable.
Okay, thank you. There's probably time for one last question. In the earlier slide, there was showed there were many different alternative data or additional data companies. Do you sense that over time they might merge and there might be a few big global winners, or do you think it's going to be many small companies for the foreseeable future?
Shall I pick up on that? My general consensus is, or view is, they are likely to merge, or they're startups that are likely to fail, and some will survive and pick up a certain amount of scale. So I mean, already if we think of, I mean, I've got a great passion for digital biomarkers. If you think about how many people have mobile phones in their pocket, and you could potentially assess some health things quite easily. We've already seen through some of our partnerships with Google company, with Alphabet rather, with Amazon, other kind of really large, well-known brands where we've got corporate partnerships with, some of them being bought. I mean, that's probably less about the insurance proposition, more the kind of the economics, but I suspect that it will take its kind of natural course with some startups, many failing, and some achieving scale and surviving.
Okay, thank you. Oh, please go ahead. Yeah.
No, thanks, Tim. No, thanks, Dave. I was actually chatting to someone about this yesterday, and we are already seeing some mergers in the market. Some of which are confidential and behind the scenes, but you do see players in the insurtech world actually merging with players, kind of your, let's say your Googles or Amazons or Apples, that almost your tech world is starting to integrate with insurtech worlds. There are some interesting things that we're seeing out there, and this will only continue as time develops. But there probably will be a substantial amount of different insurtechs for a good period as well.
Okay, thank you very much. I think we will have to end it there. We've reached 1 o'clock. So thank you again, Adam and Doug. That was an excellent session. Thanks to those that put questions in too. Our next event is called Solvency II Reforms Update and is on Friday, the 18th of November, and will be presented by Anthony Plotnick and Kenny McIver. If you have any questions, please feel free to contact Noka at contact@noka.uk. Thank you for attending and have a nice weekend.
Thank you very much to Tim and Noka.
Thank you all. Been such a pleasure. Bye for now.